Good morning, everyone. Matt Dana, managing partner of Dana Whiting Law, and Mr. Trevor Whiting, partner of Dana Whiting Law.
Hey, Matt, how you doing?
Good to have you here today. And as usual, Trevor and I side by side, we're going to get each other worked up and talk a few code sections. And we're going to talk about today, Trevor. I know we have, we have on many of our videos where we talk about a squeeze, freeze, and a please. And today we're going to focus a lot in on that second one, the freeze. And we've talked about the freeze before. Tell us just quickly what a freeze is, and we'll talk about that a little bit. And then we'll switch gears and we'll talk about something related to a freeze.
Yeah, a freeze is a technique that we start looking at after somebody's gifted away their exemption amounts. And right now with this new tax bill going into 2026, that exemption amounts to $15 million per person. And so we're talking about clients with net worths over that limit, married couple, so over 30 million. We've gifted away the exemption amount into our green boxes, our slats, or a trust for the kids or grandkids. And now we still got assets that are red, that are subject to estate tax when the client passes away. And what we're going to do on the freeze is we're going to take those assets and we're going to sell them to the green box. And so we don't need more exemption. We've used all of our exemption, but you need exemption when you make a gift. But this isn't a gift, this is a sale.
Fair and adequate consideration.
Yeah, if there's 10 million of assets, we're going to sell it for $10 million. And that trust is going to give a promissory note and saying, the trust will repay $10 million over 15 years or 20 years or whatever. And on that payment over time, the balance on that promissory note is going to shrink. And what we're hoping is that we pay that note off, it shrinks down, and when the client passes away, the balance remaining on that note is zero. And we've got all these assets in the green box that they've received. The green box received it by gift and by purchase from the client.
This is an example here. I'm talking about selling 25 million over to a green box. And if you look at the flow chart, the seller's John Doe. He's got red assets. The asset that he's selling is a limited partnership interest in Doe Family Limited Partnership. And you can see Doe Family Limited Partnership has $58 million in it. There's our squeeze. We're going to take a 30% discount because what we're selling is a minority interest, a non-voting interest, and we're going to discount the 58 down to 30 by 30%. And so the discounted value of the partnership is $40 million. Now, Trevor, these numbers are a little bit, they're not rounded off. This is an actual client, an actual presentation I think we made last week to somebody. First thing we do is we take that squeeze and get 58 down to 40. And then in this hypothetical, the client's going to sell 25 million over to a green box. And there again, that green box could be a slat. This particular green box is a slat, the Jane Doe Irrevocable Spousal Trust. It could be a green box for the kids, and there's lots of different green boxes we talk about. Trevor, walk us through this payment and what it looks like and how the numbers work on that.
Yeah, so that we're selling about a 67% interest in that LLC, so it's about 2/3 of the LLC. It's going to be a non-voting interest, so there's that discount. The sale price is $25 million, Matt, and we structured that promissory note where it was payable over 20 years, but the first 5 years were payments of interest only. And so that quarterly payment on the interest only is $292,500, and that's based on the AFR, which is what we call the applicable federal rate, published by the IRS for the month that this transaction was done. So that 4.68% is the interest rate that the IRS says we have to, that's the minimum rate we can use for a loan like this. And so we structure it as a interest-only payments for 5 years, and then there's going to be principal and interest paid over the remainder of that month.
And Trevor, I remember this case very clearly. We're still working on it. This client, their total estate and their total net worth was probably 60, 70 million. This 58 million here is really the value of a company. And the reason we structured it where the first 5 years it's interest only is because we've got to have enough cash flow to make that payment. And remember, the interest rate's immaterial because we don't pay income tax on that. This green box is a grantor trust, Trevor, meaning that when the red box sells to the green box, that whole transaction is ignored for income tax purposes.
So we don't trigger capital gains.
Don't trigger capital gains. We don't have to worry about interest income.
Yep.
It's a non-issue. Where does the green box get the $300,000 a year it's going to need to make this payment back to the red box?
Well, first of all, Matt, that green box already has some assets in it.
Yeah.
And so it's got some assets in it. So it's going to have some income and some cash there to help make those payments. But it's also going to be receiving distributions now from that LLC on that 67% interest that it's purchasing. And so that Doe Family LLC will make distributions. 2/3 of those distributions will go into the green box, the spousal trust, and then that spousal trust will receive its cash and it'll make its payments according to that promissory note back to John Doe, the seller.
Now, from an estate planning standpoint, let's say 10 years from now, that company doubles to $100 million. How much of that's still green?
Yeah, 67% of it's still green, 67 million of value.
Yeah. Isn't that a miracle in and of itself? It bought that 67% for $25 million. 10 years later, it now owns $67 million worth of assets. There's that appreciation we're talking about.
Right.
In a green box, once green, always green. The red box is frozen with that $25 million note. So very, very classic freeze technique. And I remember we structured it with the 5 years of interest only because the family thought the company's going to be sold in the next 5 years. So that $58 million is not really liquid. It was in a company. And if I remember, the company doesn't pay a lot of dividends. The dividends maybe were total $2 or $3 million. But once the company sells, then we can bump that payment up. And
we might pay the note off completely. We'll have a lot of flexibility when there's that liquidity, and we can, we've got it structured so that they can continue to make that payments and just shrink that note over time, or just pay it off and be done with that transaction.
The nice thing, Trevor, about you and I working together for the last 15 years, we can cite clients that we started with them, and maybe these sales that we structured were, at the time we structured them, maybe we sold 50, 60 million. But then there again, we saw that mushroom into 100 million to 200 million. There again with our clients, just watching their businesses grow over the years, right?
Right.
And the other thing to say is, this transaction, it's not accurate to say that from the beginning, this really didn't reduce estate taxes because John Doe sold $25 million to the green box and John Doe got back a $25 million note. So somebody would argue that didn't shrink estate taxes at all in the beginning. Why is that argument false?
It's false mainly because of the squeeze.
Yeah.
Before we set up the family LLC, that 67% interest in the LLC would have been worth, almost 50 million. But with that squeeze and that discount for lack of control and lack of marketability, we got a benefit of getting a lot more assets into that $25 million sale.